As we begin to gain wealth or save more money, perhaps you doubled your profits on GME. What is the next move? How can you take your investment further and maintain or grow your wealth? Build on something for your children. In this episode, Flash Instincts will give you opportunities, options, ideas for your future. Now let's get started. Before I begin, I'd like to say this is not financial advice. Invest with your own intellect and due diligence. Subscribe to this channel for more content. Today we're going to look at REITs, at dividends, at ETFs, and we're going to try to explain the difference. Particularly, we're going to focus on the dividend yield percentage. We want passive income while doing absolutely nothing. You're sitting there with money. Free income. Imagine $300,000 that you have saved. You put it into a REIT dividend yielding ETF. This is a company, perhaps IVR, perhaps YYY. We're going to mention these tickers in a bit. But imagine putting $300,000 and every year while you're doing your job, maybe you're a doctor, maybe you're a businessman, a financial advisor, a bioinformatician, perhaps you're even a teacher, a professor, and you do not have time to invest like everyone else. But you don't want your money sitting there doing nothing. Perhaps you're scared of other types of investments, but this one is a solid, a more easier type of investment. And this is putting your wealth in an ETF that has high dividend yield percentage. Now, that $300,000 every year is going to reward you for a potential $30,000 gain. So before I begin, I'd like to give some definitions. What is an ETF? An ETF is an exchange traded fund. It's a type of security that tracks an index, a specific sector, a commodity, or other asset. But it can be purchased or sold on the stock exchange, just like a regular stock, okay? There's oil ETFs, there's real estate ETFs, there's esport ETFs, there's technology ETFs, there's all types of ETFs. We're going to particularly focus on high dividend ETFs. And what is a dividend? We're going to define what a dividend is. It's a sum of money paid regularly, typically quarterly, by a company to its shareholders out of its profits or reserves. Basically, this is passive income. A dividend is when you invest perhaps $300,000 into a company and they reward you. They give you a percentage based every quarterly. This is 4 times a year. This is the most typical way it's done. Some companies do it more often, some do it less, and you get passive income. People say diversify. This is a way to diversify. Again, make sure you hit the red button. That subscribe button is there. We got content for days. So according to Investopedia, a REIT is a real estate investment trust. It's a company that owns, operates, or finances income-generating real estate. They're modeled after mutual funds. REITs pool the capital of numerous investors and make it possible for individual investors to earn dividends from real estate investments without having to buy, manage, or finance any property themselves. So you're trying to get into the real estate industry. You don't know anything about it. You want to make money regardless. This is your opportunity. This is your door opening up. This is the portal. Okay? Flash Instincts got your back. This is the point of the video. So today we're going to look at a couple of REITs. We will also look at other options for high yield dividend percentage payoffs for your portfolio. We're going to begin with IVR, Investo Mortgage Capital. It has about 220 million float. So the potential to double your stock value is there. During COVID, it hit $7.92, a very high price, $8 range. This was a pump, then it dumped, went back, and now it's slowly rising yet again. It is consistent. It has formed a cup, a 1-year cup. It is at $4. The dividend yield percentage for IVR is 8.08%. So that is a very hefty, nice value. Now on comparison, we can look at another one known as TWO, Two Harbors. Two Harbors is another REIT, okay? They're investing in real estate and you don't have to do the work. Two Harbors, TWO. I'm gonna look at the chart real quick. TWO. Very similar to IVR. If you look at the chart, crazy down pattern, sell off because of COVID. Now we are rebounding and it is consistently going upwards. Okay, you might have a little sell-off very soon because the RSI is indicating overbought. However, let's look at the yield percentage. TWO has a 9.38% of dividend yield return. That means this is close to 9.3%. Let's just say 9%. With the fees. Some dividend companies, you have to pay fees. You have to subtract some of the fees percentage based on their investments. They will increase those fees if need be. Those fees you have to look at very importantly. Usually real estate investment companies, they have low amount of fees. Okay, so these are really, really optimal. You'll look at it, it is also catching up to its previous highs. Slowly but surely, 50% of the way, okay? Leading to a rising wedge potential. We might have a sell-off. But remember, anytime you enter these positions, these are long-term plays. So you're looking at the dividend yield percent gain. At the same time, your stock value can double. This means that you're getting huge generational wealth added to your bank. You have to do your calculations before you purchase any of these. Look deeply. Now the next ticker that you can look at is YYY. Triple YYY. This is a more interesting one. It's a high leveraged one. This is an amplified ETF. What they do is that they already invested in very high yield ETFs, okay? And they're doing the research, the due diligence for you. You don't have to worry about real estate or any of those companies that they're investing in going up or down. They're taking care of that. So basically, they have a dividend yield of a near 10%, but they have expenses because they're doing so much research and trying to get the best percentage gains for you. There's a 2.17% of expenses. So instead of 10%, you're looking at about 8% gains. Now, this is not bad if you consider what the job that triple Y or amplified high income ETF is doing for you. Now, I'm gonna look at the chart real quick and I'll show you exactly what I mean. This has recovered even better, more powerful than TWO and IVR combined. It has almost reached back to pre-COVID levels. It is not there yet, okay? But at least you have an idea going forward where you can store your money. It is overbought right now due to RSI levels, especially on the 5-year chart. This shows that it's extremely overbought. You can always be patient with these and enter at a lower time. It looks like a rising wedge. Maybe it will have a sell-off, and when the sell-off occurs, you can potentially enter. It might even go down to $15. Right now, it is currently at $16.74. Pre-COVID, it was $18. Now, this is a different form of investment, guys, and we're looking at different options to store our value so we can gain higher return rate over long-term periods. All right, now this is just 3 examples of REITs, dividend yielding percentage, high dividend yield. I'm going to give you other options. There is a technology-based, a communication-based stock, Lumen Technologies. This has about 7% dividend yield, and it's a really interesting one. High RSI at the moment, but it is not extremely highly priced. You'll notice there is a downturn due to the current retracement for technology. Okay, maybe this is an opportunity for you. It actually has hit $11 recently. So look, it's a great opportunity, double bottom. Now, this is just one example. Another example that a lot of big growth companies like to invest is our genomic or genetic related biopharmaceutical dividend yielding stocks. This is G-Lead, for example. This gives about 4 to 5%. Okay, and this has potential long-term gains because they're involved in cancer research. Then we have another sticker. Instead of G-Lead, we have ABBV. ABV. Everybody's into this one. It is a safe stock. It does not plummet or does not crash suddenly. ABBV, yeah, this is another interesting one. You'll notice that it ranges from $98 to $110. It doesn't go any further up or down. This is just a solid play. This is made to protect your investment. Their dividend yield is extremely nice, 5%, guys. Also, the next one I want to talk about is AT&T. AT&T. We all know about AT&T, but they're famous for dividend yield percentage. No matter what, during this whole crash, AT&T never let its investors down. Its ticker is T. Okay, AT&T. This did not crash much. Fluctuates from $23 to $36. It does not go any further down or above. This is a very long-term safe stock for dividend gains. You'll notice that since 2017, we're almost at the same resistance and support line. From 2017, 6.91% dividend yield. This is extremely nice. This is a beautiful one. AT&T treats its investors nice. I hope I was able to give you guys some sort of ideas on how to gain passive income investment ideas. If you like this content, make sure you hit that red subscribe button. I got more plays for days. We're all trying to build generational wealth here, and if I can help, if we can help each other, let's do it. Until next time, I'm out, guys.